If it seems like your money isn't worth as much as it used to, you are right. America is riding the largest inflation wave since the Great Recession of 2008. Food, rents, gas, we are paying more money on almost everything. The Federal Reserve said inflation is a sign of economic recovery from the pandemic, and recent price surges are still within control. But let's take a step back. Simply put, inflation means the prices of goods and services in an economy are rising, and there are several reasons why it happens. Inflation occurs when demand outpaces supply in the market, but it can also be triggered by the rise of production costs. For example, when natural disasters damage manufacturing facilities, or there are shortages of raw materials. The influx of money introduced by loose monetary policies can also stimulate investments and consumption, which bump up prices across different sectors. But right now, it's rebounding consumer demand that's to blame. The Bureau of Statistics reports that the overall inflation rate has risen 4.5% since last July. After more than a year of staying at home, people are going out and traveling again. Take a look at the used car market to see the trend up close. Prices spiked more than 45% over the past year. Bottlenecks in the manufacturing supply chain aren't helping either. Home appliances and furniture both saw the prices swell, with the cost of washing machines increasing by 17.9%. The staggering hikes are also found in oil prices, which grew by 39.1% from their lows last July. Although countries like the US and China are demanding more oil as they recover from the economic downturn, the major oil suppliers are not rushing to crank up their production so they can maximize their profits. This isn't the first time the US has experienced high inflation.
I have directed the Secretary of the...
Starting from the early 70s, the Fed under the Nixon administration boosted the economy by adopting a cheap money approach, which lowered interest rates and allowed more money to circulate in the market. Meanwhile, despite the massive budget deficit, President Nixon poured money into social welfare programs like Social Security to get support for his re-election in 1972. And it worked. Nixon won 49 states. But the cash flow plus the government's overspending overheated the market, so inflation rates soared to double digits by the late 70s. That's what some economists fear will happen if the Biden administration's $1.9 trillion relief package and ambitious infrastructure investments pass Congress. One Yale University think tank predicts that the $1 trillion stimulus plan combined with strong consumption will put the inflation rate at around 5% by the middle of 2022. And if the Fed raised the interest rate from the current 0 to 0.25% to about 3%, that will mitigate the inflation by 1% next year. Well, put the numbers aside, prolonged inflation is detrimental to an economy. It first hurts the low-income population as they spend most of their money on necessities and cannot cut back their expenses immediately. Also, when the prices of commodities in one country surge, they become less attractive for other countries to buy, so the exports will decline. One other not-so-obvious consequence is malinvestment. You see, when the prices of houses go antiques, the so-called existing assets keep climbing, it pulls money from investors. But the rise of nominal values of these existing assets won't directly contribute to a country's productivity. So when more capital is funneled into these assets instead of spent on innovative ventures, it derails a robust economy. For years, the Fed failed to meet its goal of trying to maintain a 2% inflation a year for maximum employment and price stability. So, for now, it plans to let inflation hover above 2% for a while but won't let it go rampant.
The Fed's policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. As the committee reiterated in today's policy statement, with inflation having run persistently below 2%, we will aim to achieve inflation moderately above 2% for some time so that inflation averages 2% over time, and longer-term inflation expectations remain well anchored at 2%.